Goldman Sachs CEO David Solomon said this week that there is a very reasonable possibility that we could have a recession in 2023. JP Morgan CEO Jamie Dimon also predicted that the U.S. could enter into some kind of a recession 6 to 9 months from now. What are these predictions worth? Is a recession in the U.S. indeed inevitable? What does it take to get a recession anyway? And what does it mean for your money? I'm David Wu, a former Wall Street strategist with a 20-year track record of making actionable predictions about major global change. Welcome to The Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. Before we begin, please hit subscribe and the bell button so that you'll be notified when a new video comes out. The financial market is a giant mirror reflecting people's expectations about the future. Investing is about making bets on the future, or at least the market's changing expectations about the future. Making good predictions, of course, is hard, very hard. But once a year, it is all about looking into the future on Wall Street. This happens in December when Wall Street banks release their year-ahead reports and forecasts. This year, the theme is recession. Recession is on every pundit's lips. Wall Street consensus is that there's a 62.5% chance of a recession in the US over the next 12 months, an 80% chance in Europe, and a 90% chance in the UK. Because investing requires looking into the crystal ball, Wall Street is big on leading indicators. Two leading indicators of recessions have become part of the received wisdom, or if you like, baggage on Wall Street. One is the shape of the yield curve. When it becomes inverted, that is when long-term interest rates fall below short-term interest rates, it is usually thought a recession is not too far away. This indicator has a great track record of predicting recessions. However, what it really means is that central bank interest rate hiking cycles often end in a recession. Right now, the spread between 10-year US government bond yields and 2-year government bond yields is at 82 basis points, the highest in 30 years. The second indicator is the ISM Manufacturing Purchasing Managers Index. When it dips below 50, it is often thought that recession will soon follow. This indicator also has a decent track record of predicting recessions, despite the fact that manufacturing is only 12% of GDP. What this says is that when economic horizon darkens, people tend to cut their spending on manufactured goods like cars and electronics before they reduce their spending on services like healthcare or transportation. Last month, this index went below 50 for the first time in 2.5 years. The fact that these two well-regarded indicators are now saying that a recession is coming soon is why you don't find many people on Wall Street willing to take the opposite side of the bet. At least not in December, when markets are driven usually by the big consensus about the outlook for the following year. Nevertheless, this shouldn't stop us from asking whether a recession in 2023 is indeed a foregone conclusion. Why do interest rate hiking cycles often end in a recession? The reason is simple. Interest rate hiking cycles are usually preceded by interest rate cutting cycles that encourage debt accumulation and asset price bubbles. Interest rate hiking cycles precipitate recessions by tightening the supply of credit and bursting asset price bubbles. This was the case in the run-up to the Great Recession of 2008-2009, when we saw a massive increase in household debt and a housing bubble. The Fed hiking cycle that ended in the 2001 recession was preceded by the dot-com bubble. In a nutshell, high interest rates alone do not guarantee that we'll get a recession. We also need debt buildup and asset bubbles. So are there any debt problems and asset bubbles today that we should be concerned about? Let's first consider debt and leverage. The balance sheets of the US private sector are strong. For example, U.S. household net worth to disposable income ratio is near an all-time high, while household debt service as a share of disposable income is near an all-time low. This is why, despite some tightening of lending standards on credit card loans over the past 2 quarters, banks are far from turning off the tap. Banks can see that the unemployment rate is near its all-time low. They can see that there are 1.7 times more jobs than there are job seekers. Gainful employment is the single most important determinant of anyone's ability to service and repay debt. This is why the delinquency rates on credit card loans and residential mortgages are near their lowest levels in decades. American consumers are in exceptionally good shape, even if depressed consumer confidence may suggest otherwise. What this means is that consumers are unlikely to suddenly pull back on their spending, at least not without losing their jobs or having their stock holdings blow up. If U.S. consumers are well positioned to cope with higher interest rates, what about corporate America that employs them? Corporate debt has been rising faster than corporate revenue over the past 10 years. As corporate profit growth has slowed over the past year, banks have tightened standards on commercial and industrial loans. Should this be a concern? Only if the tightening continues. However, corporate profit margins are still near their all-time high. Delinquency rates on business loans have remained very low, and credit spreads for even the riskiest businesses are still pretty tight. In other words, banks have no incentive to put the big squeeze on corporate America, at least not yet. Especially given they don't have to if they don't want to. After 10 years of Dodd-Frank, the average Tier 1 capital ratio, the most important measure of the health of the banking system of U.S. banks, is 30% higher than at the start of the Great Recession. In other words, banks have plenty of cushion to handle any unexpected shocks. If anything, the bank's problem right now is that they're still sitting on a lot of liquidity and their interest rate margins are still low by historical standards. The bottom line, with a big chunk of the U.S. private sector debt having shifted to the U.S. government balance sheet, the ability of the private sector to cope with the Fed's interest rate hiking cycle is stronger than at any time over the past 2 decades. As for the U.S. government, the fact that the U.S. dollar remains very strong means that the U.S. government does not have a problem borrowing money, especially with the Fed hiking interest rates. So what about asset bubbles? Are there any bubbles that could burst and push the U.S. economy into a recession next year? The U.S. residential real estate market is clearly overvalued. A key metric, the price-to-income ratio, is now higher than at the peak of the last housing bubble in 2005. If the housing bubble were to burst, then we will certainly go into a recession. The Fed hiking cycle has driven mortgage rates to their highest level in years. As a result, mortgage applications have been in a free fall. However, this has not brought down home prices. Believe it or not, home prices are still up 10% on the year. This is largely due to the fact that inventory remains tight, partly reflecting the underbuilding over the past few years. As much as home prices will have to come down, at least in real terms, over time, it does not seem that the Fed hiking cycle will burst the housing bubble and crash the economy. Is there any other bubble out there that can pop and push us into a recession? Yes, indeed, the U.S. stock market bubble. Over the past week, the spread between S&P 500 12-month forward earning yields and 10-year yields on U.S. inflation index bonds has declined to just 4%, to the lowest level in more than 10 years. This suggests that the risk premium on U.S. stocks is very low, especially if we are anywhere near a recession. Yes, normally in recessions, investors demand higher risk premium for holding risky assets like stocks. The conclusion is that U.S. stocks are very expensive. It may be because the stock market attaches a low probability of a recession, or that it thinks inflation will soon decline sharply, allowing the Fed to start cutting interest rates. Whatever the reason, the U.S. stock market is the elephant in the room right now. If we enter a recession, the U.S. stock market will certainly fall a lot. Conversely, a 20-30% fall of the U.S. stock market, for example, in response to higher than expected inflation readings, will likely push the U.S. economy into a recession. This obviously has important investment implications. Popular leading indicators tell us that a U.S. recession in 2023 is all but a done deal. However, exceptionally strong private sector balance sheets mean the U.S. economy can weather the Fed tightening cycle better than in the past. Low housing inventory will give time for the housing bubble to adjust gradually. Lofty valuation of the U.S. stock market poses the greatest downside risk to the U.S. economy in 2023. If you got something out of this program, please hit like and subscribe to my free YouTube channel. If you want to learn more about my investment strategy, come check us out at davidwuunbound.com. Thank you for listening.